In this video, I am going to discuss about aggregate demand and aggregate supply. Let's get to know about the demand first. Demand refers to the amount of a good or service that consumers are willing and able to pay at a given price. In order to become a demand, willingness and the ability to pay should be there. It is a fundamental concept in economics that helps to determine the market price and quantity of a good or service. For example, demand for smartphones. If the price of smartphones decreases, consumers are more likely to purchase them, leading to an increase in demand. As demand increases, companies may respond by producing more smartphones to meet the increased demand. On the other hand, if the price of smartphones increases, consumers may reduce their demand for them, leading to a decrease in the quantity purchased. This decrease in demand may result in companies reducing the production of smartphones. Simply, if the price for a good or service increases, demand will decrease. And on the other hand, if the price decreases, demand will increase. The price and the demand are inversely related to each other. Now let's talk about the aggregate demand. Aggregate demand refers to the total demand for goods and services in an economy, representing the sum of demand from all individuals, businesses, and government entities. This is not the demand for individual good or service. This is the total demand for goods and services in an economy. Aggregate demand is a macroeconomic factor. It is a measure of the total amount of spending in the economy, and it is a key determinant of the level of economic activity and national income. Aggregate demand is inversely related to the price, which means if the price levels of goods and services increase, the aggregate demand will decrease. If the price levels of goods and services decrease, the aggregate demand will increase. Now let's talk about the components of aggregate demand. These are the components we can use to calculate the aggregate demand in an economy. Consumer spending on goods and services. This denotes by letter C. Business investment in capital goods. This denotes by letter I. Government purchases of goods and services. This is also the government spendings. This denotes by letter S. Spending by foreign entities on domestically produced goods and services. These are the exports. This denotes by letter X. Spending by local entities on internationally produced goods and services. These are the imports. This denotes by letter M. Using this equation, we can calculate the aggregate demand in an economy. It is the summation of consumer spending, business investments, government spending, exports, and minus the imports. This is the aggregate demand curve. The y-axis depicts the price, whereas the x-axis depicts the quantity of goods and services. As the price increase, the demand will decrease. This is the depiction of this aggregate demand curve. As the price decrease, the demand will increase. If the price increases, the demand will decrease. If the price decreases, the demand will increase. And there is another phenomenon in an economy where the price stays at the same level but the demand will increase or decrease. If the national income decreases, the aggregate demand curve will shift to the left side like this. The price will stay the same. And when the national income increases, the demand curve will shift to the right side like this. The price level will be the same as earlier. Now let's talk about the supply. Supply refers to the amount of a good or service that producers are willing to and able to offer for sale at a given price. The willingness and the ability to offer should be there. It is another fundamental concept in economics that helps to determine the market price and quantity of a good or service. For example, supply of coffee. If the price of coffee increases, producers are more likely to increase their production of coffee to take advantage of the higher profit margins. As the supply of coffee increases, the market price may stabilize or even decrease. On the other hand, if the price of coffee decreases, producers may reduce their production of coffee, leading to a decrease in supply. Price and the supply are positively related, which means if the price increases, supply will also increase. If the price decreases, supply will also decrease. Now let's talk about the aggregate supply. Aggregate supply refers to the total amount of goods and services that firms in an economy are willing and able to produce and sell at a given price level. Aggregate supply is a macroeconomic factor. It represents the capacity of the economy to produce output and is a key determinant of the level of economic activity and the general price level. Aggregate supply positively related to the price. Here is the aggregate supply curve. The y-axis depicts the price levels and the x-axis depicts the quantity. As the price is increasing, the supply will also increase. As the price decreasing, the supply will also decrease because those two are positively related. This is the supply curve for short term. This means the economy is utilizing the resources and increasing the employment. As the full utilization of the resources and the employment, this will be the long term aggregate supply curve because the economy is now at the highest capability of producing goods and services. This is where the supply will stay the same but the price will start to increase. This will happen in the long term. Now let's talk about the equilibrium price. This is where the aggregate supply and the aggregate demand will equal to each other. At this level, the price will be called the equilibrium price and the quantity of the demand and the supply will at the equilibrium. Thank you for watching. See you in the next video.